afternoon, folks. Mark here with Flipside Trading, and today we're going to talk about the trades of the week of March 29th. First of all, we'll talk about how we navigated the trade war tensions and at the same time the Twitter tirades. So a lot going on there. A couple things to note, right? Definitely hit our target, 1650. Notice we put on all our trades on the 28th and they expired here on the 29th. The reason is we had to wait and see what the market was going to do and declare its intentions, then apply the proper strategy in order to be profitable. We're going to talk about the overall trade wars and how we actually work that with the XPX, and we bounded it with a call and a put vertical. And we'll talk about Amazon and how after Twitter came out, we're able to take advantage of that volatility. All right, so without further ado, let's go ahead and look at the charts and see what makes sense. Okay, here we have the SPX. We know it's moving in a downtrend. You can see that it broke this, right? This trend line right here, and it's moving down. The only thing that's holding it up at this point in time is this simple 200-day moving average. So it's a small, thin line. So at this moment, you don't know if this support is going to hold, right? Your momentum is still kind of downward. Your price action is downward. But are we going to be able to keep and sustain a bounce? So in order to make some of those determinations, we need to go ahead and look deeper into the market internals. So we're going to, let me go ahead and take the screen draw off and go to the internals here. So there's two things on the internals. So right here, this is a graph of the VIX. And the VIX basically right here is a measure of the uncertainty, therefore the volatility in the market. And you can see here that it's bounded by what we call the Bollinger Band, so this is red line. And here it exceeded this Bollinger Band and it popped out. Usually it's going to continue going up, that it'll kind of stair step its way. And then, but if it doesn't, if it closes underneath, right, and underneath this red line, it usually means that it's going to stay contained within this range. Now the relationship between volatility is the following. As the VIX rises and the uncertainty increases, the S&P will drop. Conversely, if there's no uncertainty and everyone's calm, they feel they know what's going to happen in the market, volatility goes down and then the market goes up. So in this case, we're saying, hey, there's a good chance that the market could go up, but again, all we have is that 200-day moving average. So I want to take a look at something else. And that's over here, and it's known as the put-call ratio. Remember, puts, the number of puts that are put on, if you're long a put, it means that you're short the market. What happens is here, you can see that we're very high over that extreme of 1, okay, on the day. We're at 1.2. And this white line, which is a 10-day moving average of that put-call ratio, shows we're at the extreme and over the ratio of 1. Therefore, the ratio of puts to calls is greater than 1, which is telling you at a very, very large extreme that everybody is short. So if everyone is short, you can see in the past, when we get to that extreme, that the market tends to bounce, right? It tends to bounce right here. Now, when exactly that's going to happen, we don't know, but it's something we just need to be aware of. So we have this opportunity where we can go lower and opportunity to go higher. So how do we take both of those into account in the trade with SPX? Well, let's take a look at XPX here. Let's get out of the screen drawing tools and we'll go back to the charts. And we're going to go back down to a 5-minute chart. And we'll go back to the day that we placed the trades. That's here on the 28th. So you can see here that we had this downward move that arrested itself here the day before. We came and we retested that same level the next day. Notice that when we tested the level, we formed a formation known as a double bottom. Now this pattern is key in the sense that the overall price level was about the same, but the momentum is actually increasing. So this is telling us there's a high probability, given also with the put-call ratio that we talked about and the VIX that it may go up, that we can think that the market will go up. And sure enough, the market started to move favorably in our direction. So we went ahead and we placed a short put vertical, right? We sold a 25.30 short put. So that gives us, we're at 96, so we're about 66 points of cushion, which is huge. I mean, right now we're kind of moving in 30-40 dynamic ranges, so we have an extra cushion of about 20. So that really sets us up well for the bottom boundary. Now the question is, we still want to hedge our bets, right? We don't know which way this is going to go. If we're bounding on both sides, at least one side wins. So as you can see, we came up here and started making this high, and we made this high, we went a bit lower. So now we start having the trend is showing us it's moving down, and momentum is moving down. So we took advantage of that volatility. Now we legged in when this is very, very high. It allows us to have more room, right? A bigger push, and we put the short strike on the call vertical up at 26.85. So if you look at that, again, it's another 60 points. So we're betting that the market's not going to move, plus or minus 60 points in one direction. So taking a look at that, all right, we look what happened during the day. The market came up, it dropped down on the Twitter news, came all the way up here, came into consolidation on a flag. We can show you something here if you're a day trader. On this flag, you can see here we have this this trend line. We have a squeeze down here, right? Squeeze breaks, and then we took the day trade for a little bit of a push, a little bit of pop. So that's nice too. But basically, going all the way to the end here, where SPX is trading now, it's trading at 26.44, which is 40 points away from our short strike. The call at 26.85, and is basically over almost almost 100 points almost 100 points away from the short strike on the put side. So this is going to expire worthless, and we're going to be able to keep the credit from both those trades. Now let's take a look at Amazon, and we'll go ahead and look at it on the daily chart first. And let's see, daily, here we go. So let's move over to Amazon. Here we go. Amazon's also moving down. What we had here is this huge gap when news came out that Trump had this animosity for Jeff Bezos and Twitter. Basically, Bezos owns the Washington Post, so there's kind of a fake news grudge. And also, a lot of Trump's buddies were saying that Amazon has a monopoly and he's overall hurting their business. So this actually, pushed Amazon down almost 100 points. And you can see that based on that 100 points, it's kind of a news overreaction. Trump kind of, people tend to disregard, or there's a short shelf life on what he says. When those things happen and the market kind of rebounds, you can see that happened, right? The market came down, found a low in its footing, and then kind of reversed. So the overall idea is that, given the kind of the short-lived the nature of these tweets, the idea was, how can we take advantage when Amazon is down here of a put credit spread way down here? So what we did is we took a look at the 5-minute chart. We'll go back down and we'll get off of that. I'll show you here on the 5-minute. We'll go back to the same type of piece. Here we are on the 28th, the day we're placing the trade. And let's see if we can learn something. Okay, so, right, we gap down, right? Gap down, right? Price continues to move down. Again, we form a bottom about the same level. Momentum kind of moving upwards, right? So we have a double bottom. This is a good spot. So we take a look and we go ahead and we set a short strike down at 1350. Sure enough, the stock starts moving away. It puts us in a very, very profitable position. The key is that since we were down this low and we set the short strike down here, we're able to get 80 cents, okay, of premium as we're closer to the short strike. If we tried to set that that same short strike at where was it? 1350. From here, we probably only got about 35 cents a premium. So by looking at these pullbacks and taking advantage of this, so it moves away and gives you a profit cushion, is very key. Not only that, it allowed us to move the short strike even further to get a lot of premium. So you can see as the next day unfolded, we had another Twitter storm, and Trump came out again and kind of said, that the government needs to do something about Amazon from an antitrust standpoint, and it drove it down. But we're able to hold that right down here, even though it came down to what was the low of the day, 1365. We were still 15 points away. Not only that, we remember our put call ratio. So the whole idea of kind of running the gamut, running short, and then coming back up was in play. And since we had a profit margin, we were able to hold on. So sure enough, we were able to hold, and throughout the day, the Amazon kept moving forward, kept climbing, kept grinding higher. And here we go. You can see that it's going to close here at 1444 in around that area with about 10 minutes to go in the trading day. Our short strike at 1350 is almost 100 points away. So we're able to keep 80 cents. And the reason why we're able to keep 80 cents and that we didn't do our 50% profit target is because this was an overnight trade. So we're able to really take advantage of all that volatility caused by our leader in the White House. Okay, folks, that's how you do it. That's how you take advantage. That's how we make money. It's been a great week. Look forward to seeing you next week. And everyone have a great holiday and enjoy Easter with the family. And we'll catch you on the flip side. All right, talk to you soon.